Welcome to Textbook Opportunity of the Day for February 2. The top-down approach, hourly chart on the left, 30-minute chart in the middle for action points, 15-minute chart on the right to finesse the entry, to get a closer stop loss, and hence to be able to increase your position size. Before I go through this particular textbook campaign from yesterday, I want to share with you another aspect of the L.I.V.E rule set and the L.I.V.E approach. Harnessing the L.I.V.E approach, you can see whether for the following day or the following period, probabilities of success favor focusing only on buy setups, or focusing only on sell setups, or being neutral and focusing on both. I shared with you earlier, in an earlier video, the concept of a promise of higher highs, having a probability factor of about 75% of the time, the higher high is made on the very next period. One can work with that very handsomely. Likewise, the concept of a promise of lower lows, simply being a larger range of the lower low and a lower high, again 75% of the time, the market will make a lower low on the very next period. In relation to a period known as an outside period, and that's simply one whereby, as we have on the 60-minute chart, we have a lower low and a higher high. That's an outside period or an outside bar. That contains a message as well for the following period, for the following hour. Because it's got a white real body, the message is take sell signals only, take sell setups only. Had that had a black real body, would have been looking to take buy signals only, or buy setups only out of the market. So an outside bar with a white real body, looking for sell setups on the next time frame, next period. Black real body outside bar looking for buy setups. So the hourly one, outside bar, up close, white real body looking for sells, and sure enough on the 30-minute we have a fake out sell, textbook. On the 15-minute view, the last bar has a lower low, lower high and a smaller range, and closing right at the highs. Now as you can imagine, it took a lot of buying power to push the prices up from that low to the close. The people who were long on that period probably are nervous, and if the market were to break below the low of that bar, in candlestick parlance it's known as a hammer formation, if the market were to break, which is bullish, if the market were to break below the low of the hammer, that in my eyes is very bearish. So I treat that as a surrogate selling setup. Entry being a break below the last 15-minute bar with the initial stop loss at the high of the last 15-minute bar. Pips at risk, about 10 pips. So your R, 1R, is 10 pips in this particular campaign. Market facilitates entry by breaking the low of the hammer bar, goes down by 1 times your range, 2 times your range, and closes near the lows of this last bar. So in the bar of entry, you've achieved a return of 2R, twice what you were risking. Common sense in my eyes would dictate to protect part of that, at least by going to a break-even stop loss level at your entry price, or protecting, for example, a 1R level. Don't let it all go back to the market, because that leaves a very bad taste in your account and in your mind. The next bar comes along on the 15-minute basis, and we have a lower low, lower high, so clearly we can lower the stop loss from the initial up there down to there, locking in about a 2R return in half an hour. The half-hour view is a promise of lower lows. So translation, 75% of the time the market will go lower, will break that low on the very next period. Why put your stop loss then so close to the current prices basis of 15-minute? Why not split your position and put part of your stop loss above the 15-minute high and part protecting a 1R level? One of the traps with trading is to have all your stops at one price level. That way either you're fully into a campaign or fully out of it. The 15-minute bar's high is broken on the next bar, so had you moved your entire stop down to the high of that bar, yes, you would have walked away with about a 2R return. Not bad. Had you put the stop on half the position there, you would have had a 1R return and part of your position still running. The very next bar, down it turns. In a previous video I shared with you the concept of a VT buy. On the 15 minute, the second last bar was a VT sell. VT stands for Von Trapp. People who were short and got stopped out, they'll want to go back short again. Those who bought this market to push it up, they're going to have their stops. So both sides can get trapped on a break of that low. The 30-minute chart provides the view of an inside bar there. Those two 15-minute bars together. Nice. Period of indecision. Next 15-minute chart bar comes along. Lower high, lower low. You can use that now to protect your second position or the second half of your first position. Next bar comes along. 15-minute, lower low, lower high. Haven't been stopped out there. On the 30-minute chart, we've broken a previous spike low. By definition, that's a fake out buy. Time to bring your stops down to the high of that bar. At least. If not, look to go long. But, February 1 on a daily chart was an outside bar up close, which dictated for February 2 only to take sell setups. Okay, so what I've shared with you is the power of not only the top-down approach, but also the significance of an outside bar. Outside bars occur at or before a market top, if it's a white real-bodied outside bar, at or below a market bottom, if it's a black real-bodied outside bar. So the hourly one, outside bar, white real-bodied, looking to take sells before the market came down. The 30-minute gave a fake out sell, nice, and the 15-minute had a surrogate sell courtesy of the white hammer bar. Trading doesn't have to be difficult. The less decisions we have to make, the easier it is. By following a rigid rule set, the decision-making process is taken away. All we have to do is follow the rules. That's it for me. Over and out. Catch you next time round.